This video is sponsored by Real Vision.
Everybody's been talking about the recent spike in the repo markets. Jay Powell said that the funding pressures are due to technical aspects that don't really affect the general economy. But can we actually trust what he's saying? Today, Real Vision published an interview with Jeff Snyder of Alhambra Investments. He's an expert in everything interest rates and funding markets, basically the plumbing of the economy. So what exactly is the repo market? And what does the recent spike in overnight rates mean for the economy? Well, that's what we're going to talk about today on this week's episode of Real Vision's The One Thing. What's going on, investors? AK here. First off, repo is short for repurchase agreement. They're basically short-term loans using securities as collateral with an agreement that they'll buy them back at a later date. The big banks use these repos to maintain their liquidity requirement that has been set by the government. The biggest risk is that the sellers might not agree to repurchase the securities if they decline in value overnight. And then of course there's also an equal but opposite risk for the buyers. Short-term borrowing relies on the assumption that the underlying securities aren't volatile, which is why most of the time those underlying securities are US Treasuries. Jeff Snyder has been on the repo case for years. Here he is explaining what actually happened in the repo markets and what got everyone so riled up.
Well, what literally happened last week was the repo rate shot up. And because it shot up, there's various linkages between the repo market and the federal funds market. And monetary policy at the Federal Reserve operates on federal funds. So as federal funds rose in the range and then actually broke out of the target policy range, that caught the Fed's attention. They can't any longer ignore something going on in the repo market that's spilling over into federal funds. So that's literally what happened, was that these repo rates skyrocketed because of a lack of liquidity, which forced the Fed to respond, which it did with these overnight repo operations that have become daily, which are now sprinkled in with term repo operations, simply because there's a lack of liquidity in the system, but we're not really sure why.
The repo rate spiked because of a lack of liquidity, which caused the Fed to start injecting liquidity, but no one knows actually why that happened. Snyder argues that the signs have been in the system for a long time, but the why is the real question.
And what I said, what I've been saying for a long time is that, this didn't just happen out of the blue. We've been talking about Fed funds and repos in this particular case, for over a year and a half. And really, that's the big message behind all of this. So when you stop and look at what's going on in the repo market, federal funds, and some of the wider issues with the fixed income marketplace as a whole, what you keep coming back to is there's something going on here. First you say there's something missing. Obviously there's something missing. We saw that last week. There's a big piece of liquidity missing. But there's something else going on here because this keeps building and building, and what happened last week was it finally broke out into the open so that everybody started paying attention to what was essentially something that had been happening for quite some time beforehand.
So what everybody was freaking out about is that enough big fish in the market, including the Fed, realized that the problem went further than just liquidity. Here's Jeff explaining what the recent repo troubles actually boil down to.
People are focused rightly because nobody really understands the system as it actually works. And that includes policymakers, by the way, sadly. The fact is that monetary policy is not a money policy. It's not about understanding liquidity and understanding this global system. Monetary policy is only about managing people's expectations, and that's what the Fed's doing. Overall, it's a lack of understanding about how things actually work. But that's not a small thing because, again, as I touched on in the beginning, this is a global monetary system that affects every part of the global economy and a lot of global markets. The main takeaway is simply that something's going on. Even if you don't know exactly what it is, you got to say, hey, something's going on here. And it doesn't seem like our policymakers, the authorities, have a whole lot of answers. And that's important too, because you have to realize that what's going on in the system, what may be going on in the system, if there's nothing behind it, if there's no backstop behind it, which everybody's taught from day one, the Fed is the lender of last resort. What if there is no lender of last resort? That's a very different kind of risk spectrum than if you thought, well, Jay Powell will just do a standing repo facility and we'll all forget about this stuff. In other words, there's something going on here. It's a substantial thing, and it entails risks not just to the repo market, not just to treasury markets, which would be a positive thing for treasury markets because people would go into those markets, interest rates would fall further, but we've already seen the effects in the global economy. Think about what happened in 2018, or what was supposed to happen from 2018 to 2019. Authorities were saying the economy's booming, inflation's going to break out, we're going to do more rate hikes in 2019. And what happened in 2019? The opposite. We've got questions about a global recession. Some economies that look like they're already in recessions, important ones like Germany, that already look like they're in recession. There's no inflation. Inflation expectations have fallen, as I said before, since May 29th. And oh, by the way, now the Fed's cutting rates, and they're not the only ones. It's global. Central banks around the world are all cutting rates. So we've already seen the effects of the global monetary tightening. What we're really talking about here is a global monetary tightening in the system that very few people understand. And it's already had serious effects in the entire global economy. So what this repo rumble, or whatever it was last week, it just emphasizes this fact that there are negative monetary risks that have very real implications for pretty much anywhere around the world.
So it's a global monetary tightening and everyone blames the trade wars. But Jeff isn't confident that the central bankers have caught on to the real hustle yet either. He says that the problem is systemic.
What we're really talking about here is a credit-based global monetary system, and credit-based means something. It means that it requires bank balance sheet capacities for this thing to operate in at least the appearance of stability. And if the banks aren't willing to put in the resources, to put in the liquidity, to put in the balance sheet expansion for that system to operate, it is inherently, the inherent instability in it shows up. And it shows up in these discrete periods that we've talked about, these 4 different dollar shortages that have erupted along the way. So 2008 was a monetary break. It was a systemic break, and collateral is just one part of that systemic break. But a lot of it has to do, and what we all come back to, again, we're asking the question, where are the banks? Why are they sitting on their hands? That's the reason. If you're looking at it from an overview perspective, going back to 2008, the system was never, ever fixed. That's the real point here, is that there's really survivability at stake here, because that's what we saw. Bear Stearns went out of business. I mean, yes, Bear Stearns was merged, and as far as the Fed was concerned, that was a successful rescue. But if you're a manager of Bear Stearns, you're a shareholder of Bear Stearns, that's not how you view it. You lost everything. The partners of Bear Stearns and the shareholders of Bear Stearns, they saw what the downside of this is. And that message was transmitted to all the rest of the banks. And so they understand post-crisis, there's no Fed behind everything, liquidity is shaky, and you know what, we don't really want to do this anymore. Even when the repo rate's 10%, that's not really enough, because we're aware of the potential downside and the potential risks that could be out there. And oh, by the way, the Fed isn't.
Few people understand the credit-based global monetary system that has emerged since the 2008 crisis. Snyder argues that this system was never fixed after 2008, and because it's broken, the big players are less willing to deploy those strategies that they saw bring down the system in 2008. It's not so much that everything changed since the last Fed meeting, it's more about the big players have changed their behavior after realizing what's going on. In other words, if the big players stop picking up pennies in front of steamrollers, even if you don't know why, you should get out of the way too. If you want help figuring out why, or you just want to learn more about the financial plumbing of our economy, then check out Jeff's interview and make sure you subscribe to Real Vision for more. I'll talk to you next week.